Today's video, I'm going to show you a concept of money and interest rate. If you're taking IB economics, this concept is for you to learn. Okay, so there's a conception of what's the money supply. So there's a relationship between money supply. What happened is that the money supply changes the interest rate. So as you can see, there's the term money supply and interest rate. And when you draw it in the graph, what you have is the quantity of money in the economy in associate with the interest rate. And the government, okay, is the entity that can control the money supply. So the government, I'm going to show here, is the entity that can increase or decrease the money supply in the market. So if you look at the market, what the government would do is they would set the money supply as perfectly vertical, or in economics, we call it the inelastic, okay? They have the control of shifting the money supply leftward or outward, in which causing the negative relationship of the equilibrium in the interest rate and quantity of money. So if they shift the money supply to leftward, so let's start with like money supply number 2. What's going to happen is the new equilibrium of the quantity of money will decrease. That causes in raising the interest rate in comparing to the old idea. Okay, so you can see it like that. And when they shift it to the rightward, you will also see the difference in the interest rate, new equilibrium, in which when you have more quantity of money. Why is it like that? Okay, so interest rate also known as the cost of borrowing money. When in the economy, businesses often need to borrow money to help with their function in their daily operation. They can use the money to pay down the employees or pay vendors when their revenue is not generating fast enough. So when there's less money supply in the economy, the cost to own those money is higher, or borrowing them is higher. So that's why you can see this graph. And this is a simple diagram to show you the relationship between money and the interest rate. If you have less money, you're going to have high interest rate. Okay, so you have less money, okay, less money, high interest rate, and more money, okay, so you have more money and you have lower interest rate. That's how you visualize money and interest rate in the economy and how the government can control them. And the entity that can control the money supply is the central bank. Now, let's finalize with the last concept. We're looking for a concept of when the government is going to make a decisions of either reducing the money supply, so money supply 2, or increasing the money supply, right? When are they going to start doing it? So the reason that they are reducing the money supply is that they want to contract the economy. Okay, so I'm going to call this as a contraction movement or policy. Okay, policy action. And if the government want to increase the money supply, if you can shift outward, this is what we call the expansion, okay, policy action, where they want to speed up the economy. So the government will choose in between. Now, why do they do that, right? In what circumstance are they doing it? Well, for the contraction policy, the government often do that when they are needing to fight inflation. Okay, so when everything is too demanding, too hot in the economy, there's overheating, the government need to slow it down, they can implement the contractions. Okay, so oftentimes we think of contraction as bad, but that is not. Sometimes the government can try to do that. Now, some people in favor of the government to do it and some doesn't. In theory, you can see this as an idea of making a decision, but in reality, the effect that this can happen is based on the probability. They can happen, they may not happen. Same with the expansion, right? Some people would favor the government to expand the economy and some don't, right? If the government expand the economy, they can run into the mistake of making it too heated, okay? Or there is too much inflation in there as a result of the expansionary policy, right? Too much of the money will cause the money to lose the value, and everyone's we're going to spend it unwisely, right? They're going to overspend it into good product and services that causing the inflation. So as you can see, this is the idea of the money and interest rate, okay, under the monetary policy. If you like this video, feel free to click subscribe, and I'm happy to give you more of these concepts in the future. Take care.